Welcome back to the Covered Call Masterclass. My name is Stephen Cox. I'm a full-time option and future trader, and I'm the CEO of Share Navigator. Up until now, we've covered the cover call strategy with an example with NVDA. We sold a $215 call option expiring in about 45 days' time. And we've also shown you the trade mechanics for that. We've showed you how to pick the expiry, how to go about picking the strike price. And we've also shown you how to actually place the trade. So now that we have the trade, we need to consider how we actually going to manage it. What are we going to do as we get closer to expiry? And there's a number of potential outcomes that you could choose there, and we'll go through each one in detail. But if you've missed the first few episodes, please go to our website, sharenavigator.ie, go to our option trading courses and click on the cover call strategy. The course is totally free and will be better for you to learn if you go through it in a step-by-step fashion as we've laid out in our cover call strategy course. And finally, if you like the content of this video and other option trading content that we provide, please like, subscribe, and share our channel. It really does encourage us to provide more free content for you to learn about options. So there's three ways you can manage a cover call. The first one is to let the trade run to expiry. And if you let it run to expiry, there's two possible scenarios. Scenario number one, the share price finishes above 215, and this is in our NVDA call example. In that situation, we're going to lose our shares of NVIDIA. Our broker will automatically sell them for us. We'll get the proceeds from the share sale at 215, plus we get to keep our covered call premium. The second potential outcome is where the share price finishes below $215. In that situation, we will hold on to our shares and the call option will simply disappear from our account. Fairly straightforward, so there's nothing for you to do there. The next two options for you to potentially apply to your trade management is closing the trade early or rolling out the trade. And we're going to focus in on those two now for the remainder of this video. So if we want to close out our trade early, in the options language, it's called buy to close because you're buying back the option to close out the trade. And there can be two reasons, really, generally speaking, for that. Maybe you want to lock in your option profit. It can be as simple as that, and also to protect the stock. In other words, you no longer want to get rid of your NVIDIA shares, in our example, at $215. So let's show you how you go and do that. So remember our initial trade. We took in $860 for selling the $215 call option in NVIDIA. So now a couple of weeks have actually passed since we placed that trade. And look what's happened there to the premium on offer for the $215 call option. You can see that on the second image on this screen. You can see it's $415. So we can buy ourselves out of that NVIDIA call option now for $415. So on our original trade, we took in $860. We're buying ourselves out to close the position of $415. That would mean that we generated a profit on our call option of $445. That's a cash in our account that we get to keep. And we get to hold on to our shares, and then we can decide just to stay with the shares, or we can decide to sell them, or we can sell another cover call if we wish at a later stage. We're free to do whatever we want with the shares. So when we think about rolling out our call option, it can be for a number of reasons. And the first one we're going to discuss is rolling out to the same strike. And really when we do that, we like the trade. We're still happy to get rid of our NVIDIA shares at 215, but maybe we want to generate a bit of additional premium. So that would involve two trades. The first trade is to buy back to close our original December call option. And then the second trade, we're going to sell the exact same strike price at 215, but we're extending the expiry to January. And because we're extending the expiry, the option premium will be higher than the December one, so we will generate an additional premium. Let's show you how. So we know from the left-hand side that to buy back our December call option, it's going to cost us $415. Now on the right-hand side, you're looking at the quotes there for the January expiry, and you can see there that we're taking in $661. Let's look at the profit and loss dynamics on that. So in our original trade, remember we took in $860 for selling the December call. Now we're going to buy that call back for $415. And at the same time, then we're going to open up the January expiry at the 215 strike, and we're going to generate $661. So our net income in total is $860 plus $661 minus the $415 for closing out the original December. That equals a total net income of $1,106. So remember, originally we only took in $860. Now we've increased that to $1,106. So it's additional cash that's gone straight into our account. Now we're still long the 100 shares of NVIDIA, but we've extended the cover call out to January for the exact same strike. Now let's look at another reason why we might roll out a cover call. Maybe we've changed our mind and upped our target price or lowered our target price. So let's look at upping our target price. So maybe we no longer want to get rid of our NVIDIA shares at $215. Maybe we want to sell it at $220. So what we could do is buy back our original December $215 call and then open up the January $220 call. Let's look at those options now. So we know on the left-hand side, to buy ourselves out of the December call, it's going to cost us $415. But look over on the right-hand side, you can see that we would take in $550 for selling the 220 call for January. So the ones on the right-hand side are the January call option quotes. So our original trade, our $860 we took in for the 215 call, we're going to buy ourselves out of that for $415. But now we're going to open up the 220 and generate another $550 in premium. Let's look at the profit and loss numbers on that. So now you can see that we generated a total of $995 in premium. So we generated even more. But what we've done is we've extended the strike price. So in other words, we can have a higher capital gain now on NVIDIA. Our original trade basically said we would have to sell at $215. This new trade says we can stay in NVIDIA until it reaches $220. So our capital gain will be expanded. So that's it for managing the trade. So remember, 3 potential outcomes. Leave the original trade as is. You don't have to do anything. And if your shares are called from you, in this case, our NVIDIA shares are 215, so be it. So nothing to do there. Second option, close out the trade before expiration. In that situation, you may realize a profit and then just keep your shares if you wish. And the third way is to roll out your existing call option, which involves 2 trades, buying back your existing call option and then extending the time frame to open up a new contract, usually for a credit to generate more income. And sometimes you can change your strikes if you wish, higher or lower. That will be up to you. 3 simple ways to manage your cover call option. So remember, we've covered in this course our NVIDIA example from the very basics of the trade mechanics to picking your strike prices and your expiration dates, to placing the trade, and now to managing the trade. Please visit the website again, go through sharenavigator.ie, option trading courses, and select the cover call strategy and go over it again. If you have any questions at all, you'll be able to reach out to us as well via the website, or you can type your comments in our YouTube channel. And finally, if you like the content we're providing, please like, subscribe, and share our channel. It really does help us to provide more content as we go forward. Thanks and bye for now.
Are you a frustrated options or futures trader?
That's why we built the options trading roadmap you need. Stop relying on fragmented clips. The next step is a structured program. We start with the foundations, from the exact definition of a put to the role of delta and theta. But unlike simple videos, we provide the full learning environment. Every key strategy is supported by text, video, quizzes, and live examples, so you can test your knowledge and see exactly how it works in the market. This structured approach takes you from beginner concepts to a confident understanding of basic to intermediate options strategies, and it's 100% free.
Visit www.sharenavigator.ie. Click on Options Courses from the menu. They are all free.